Hey guys, Dave Keller here with Market Misbehavior. One of the indicators I use on pretty much all of my charts of stocks and ETFs is the RSI, the Relative Strength Index. This is an indicator created by Wells Wilder. It's a perfect way of measuring price momentum. Today we'll talk about a particular pattern called the Bullish Momentum Divergence. So when I bring up a chart of a stock or ETF, there are a certain number of indicators that I always have on my chart. It starts with price, some moving averages. We have relative strength or relative performance at the bottom to see how that stock or ETF is doing relative to its peers. But then right in the middle, I have the RSI, the Relative Strength Index. It's an indicator created by Wells Wilder, really popularized in his book called New Concepts in Technical Trading Systems. I have a link in the description below for that particular book. And in his book, he sketched out literally on an accounting ledger how to calculate the RSI. And it was basically looking at the strength underlying the price movements. A lot of times what he found is when the price moves too high too quickly or too low too quickly, you probably have a bit of a mean reversion. When I was first learning about technical analysis, reading books by John Murphy and Martin Pring and others, I learned about divergences, where we're in price and relative strength. The price and RSI would do something different. That sort of work was really continued by people like Connie Brown and Andrew Cardwell and others, really popularized some of the more advanced ways to use indicators like RSI, momentum indicators. What I'm going to do today is show you the price versus RSI and a particular pattern that emerges when you have a stock in a downtrend called the bullish momentum divergence. That's when price goes lower and the RSI starts to slope higher. A lot of times that can represent that there's additional demand coming in that's not necessarily reflected in price. I'll show you three charts that are demonstrating that here in early January of 2023. Before we get to the chart, if you like this sort of thinking about investor decision making, behavioral finance, technical analysis, price patterns, if all of that is of interest to you, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below the video. Which of these three charts do you feel is the most constructive here and why? Now, as we look at the chart, you'll see first the chart of Amazon. Amazon, obviously a pretty widely followed stock. We can see how the price has been in a pretty consistent downtrend, certainly for most of 2022. If you look in the second half of 2021, while a lot of other stocks were still in an uptrend, Amazon actually made its all-time high in July of that year. November actually did not make a new high, which is pretty rare. Most stocks and certainly the major indexes made new highs in November. The S&P even made a new high in January of 22. From there, you can see this consistent downtrend pattern of lower highs and lower lows for the most part. And now the price is below two downward sloping moving averages. Here's what I want you to look at though. We look at the price here. You can see how the price is sloping downward. So from November to December, we have lower lows in the price, but look at the RSI. While the price has gone lower, the RSI is actually sloping upwards. So instead of lower lows, we actually have higher lows in the RSI. You'll note that on that first swing down in November, the RSI became oversold, which means the stock has moved basically too low too quickly. It's become too beaten down, and more often than not, you'd expect a brief bounce upwards. Then we made a new low going into the end of the year, but look how the RSI was not oversold on the second time. So that pattern where you have lower lows in price and higher lows in RSI is called a bullish momentum divergence. Basically means there's a divergence, the divergent movements between the price and the RSI, and it's bullish because more often than not when the price goes lower, on less negative momentum, that tells you essentially the momentum pushing prices downwards, sort of alleviating. More often than not, you'll find that pretty commonly at market lows. For example, just on this chart of Amazon, you can see back here in the first quarter of 2022, you can see lower lows in price, January through March, but look how we had a bullish price momentum. Now you'll see here, obviously in March, you didn't get much of a rally beyond the 200-day moving average, so this is no guarantee that this will be the bottom, just that you often find divergences like this at a bottom, and it can often be a very significant one, which is why we've learned to pay attention to them. Let's look at two other examples, and we'll talk a little bit more about how you actually play this pattern. Second chart I wanted to show you was Generac, GNRC. This is an industrial stock. Now, a lot of the industrial sectors, things like defense names, aerospace names like Boeing and Raytheon and others are in a much different phase than what you see with GNRC. Generac's actually gone down. This is a company that makes generators, right? A lot of times generators for homes and offices. You'll see a very similar pattern to what we saw with the chart of Amazon, right? This bullish momentum divergence. So lower lows in price. October, November, December, we continue to make lower lows. But look at how the RSI starts to slope downward. So back here, you see the momentum becomes oversold every time, right? So as we sell off, we become oversold. And that's more of a negative pattern, right? More telling you that the negative momentum is very, very strong. Look at how that trend changes though, right? The price is still going lower, so the downtrend is still engaged. However, the momentum is actually becoming less negative. Oversold on the first move down, the subsequent new lows, the RSI is not oversold. So you have lower lows in price, higher lows in RSI. That's actually a pretty constructive pattern. Both of those names, by the way, we're recording this on January 10th. Both of those names, Amazon and Generac, have had pretty decent weeks, actually bouncing off of the lows going into the new year. You can also find this pattern on ETFs, so we can show that here on the chart of the XLC. It's a little more in the past year. This is in September, October, November. Look at the lower lows in price. Look at the higher lows in RSI. From there, we've actually bounced up and made a higher low. Now, this gets to how we actually play the pattern. For a more aggressive strategy, just when you see a bullish momentum divergences, you could attempt to buy it there, right? Take a long position on the divergence. And the idea is you're buying into price weakness, but you're recognizing the improving momentum characteristics. What I would say is if you're that sort of trader, that sort of investor, money management is super important. What I mean is make sure you have a stop loss, because just in case that buy signal does not work, just in case the price continues lower, you want to make sure you minimize the pain on the downside and make sure you limit your downside risk on that sort of pattern. The other way to play this sort of pattern, though, is to look for some sort of confirmation. What I mean is this, right? If we look at this pattern, we can see on the chart of the XLC that $52 level, that's the peak that we had in October. And then we tested it again after the divergence here in late November, early December. We tested it once again. Now we're rotating back up to that level. So a lot of times when you do get a bullish momentum divergence, if you don't want to be that aggressive and buy into the new lows, wait to see if there are signs of accumulation. A higher low, like you see here in December, could be encouraging. A break to new swing highs, which would be above $52 a share for the XLC, that would tell you that not only do we have that divergence, we actually have upside follow through. You're actually seeing the price follow through on the pattern, and you're recognizing the price is telling you that buyers are actually coming in and pushing the price higher because of additional demand. So a bullish momentum divergence like we saw with Amazon and with Generac, and also recently with the chart of the XLC, is a sign of downside exhaustion. And what it often means is that the downtrend that has been such a part of these charts for much of 2022 is potentially being alleviated. The bullish momentum divergence will happen when the price is going lower. So a lot of times it can be a good leading indicator of the trend of a trend reversal. So I often look for stocks making new lows to see if there's any bullish momentum divergence. That's what I'm seeing right now on the charts of Amazon and GNRC. For something like the XLC, it highlights the other part, which is once you see that divergence, what do you do about it? A lot of times it can help to wait for some sort of upside confirmation. Breaking above the most recent swing high can be a great confirmation that the bullish momentum divergence may have staying power. Again, if this sort of thinking about technical analysis, behavioral finance, and stock and ETF analysis is of interest to you, I hope you'll subscribe to my channel. Be well, stay safe. This is Dave Keller with Market Misbehavior, and we'll see you again soon.